So my good brother Danny, how you feeling?
I am doing well. Nice seeing you again.
Yes, the alumni, Stratford alumni. Your birthday was recent, right?
It was beginning of October, so
Happy
another
birthday.
year older. Thank you.
Yes, husband, newlywed,
That's right.
all that. Yeah, great man, Dan. I appreciate your time that you have with me. And I just want to pick your brain a little bit, and get some knowledge out there for my customers, my clients, and just people watching.
Awesome, awesome. I gotta introduce myself too for everyone.
Yeah, yeah,
As
yeah.
you said, my name is Danny Pierro. I work for Fairway Mortgage. I'm under the Latrella Group in Shelton, Connecticut. So that's how we got connected. And like you said, talk a little bit about some mortgages and real estate.
Let's do it. So basically, let's start off, man. Let's take baby steps, because when I first started this real estate journey, I was influenced by people around me that, they would help me out, they would guide me, they would show me the ropes. But the thing that I didn't do was I didn't put the work in to study it before I started. So coming into this, a lot of this knowledge was like Chinese to me, I just figured that, it was basic stuff, but it's really not.
Yeah.
It's different. If your family is not talking about it when you're being raised, when you're coming up, you're not going to know about a lot of this stuff. So that's why, this podcast is so important to me. And yeah, like I said, let's start off slow. So tell me a little bit about mortgages, loans, and whatnot, the different types of loans that there are, conventional, FHAs, and speak about that a little bit if you can.
Yeah, so there's three or four different ones. I'll go through two of them quickly, then the other ones more in depth. Overall, I'll give high overview on all these products, but of course, if anyone that's listening wants more details, please reach out to us. We can definitely get that for you. These products do change and guidelines change also. Um, but there's VA loans, which is for veterans. You could be a current veteran or an ex-veteran, you could serve in the past, and you get different fees, discounts, and things like that for it. But you have to be a veteran to get that. So it's not for everyone. All right. There's USDA loans, and that's more for certain different areas of the country. You got to have a big plot of land, and once again, a lot of different things that change with it, but that's not for everyone. The main two loans that I really want to talk about that is for your average customer, probably for 90% of people, is either a conventional loan or FHA loan. All right. Conventional loan, it's going to be your typical, you want to put down 20%. You don't have to. You can put down 5 or 10%, but a conventional loan, you're going to usually put down 20% and you have less DTI. So what is DTI? Debt to income ratio. Okay. So that means the amount of money you make per month and the amount of debt you have per year or per month rather.
And that's why you're
Okay.
putting up to 20%, because anything less, well, you will have that DTI, correct?
Well, yeah. So if you have anything less, you have what's called PMI, which is private mortgage insurance. Okay.
Okay,
But the DTI determines all that information.
gotcha.
All right. Now, a typical DTI, meaning how much money can you afford? It's about usually 43% of your income can go towards the mortgage. Okay. And that's for conventional. But there's other programs like FHA, which is like the, assistance from the government, and they'll go a little bit higher than 43%. And you're going to get backing from the government. All right. So the government and the funding loans are going to back these things. So that's why lenders will have the ability to lend to people that can't put down or have the ability for the 43%, but maybe have 50%. Okay. And what that 43% or 50% that means is if you make $5,000 a month, all right, 50% of it is $2,500. So they're saying that we can use your $2,500 a month towards the mortgage.
And that's
That's
debt to income.
Yes, that's debt to
DTI.
income. Yep.
Okay.
And in the conventional world, it's typically around 43. It could go up to 45% in some cases, but usually 43. So if it's 5,000, you're not getting to 2,500. You might be only getting $2,000. So that's how that works.
Yep. That makes sense.
So usually FHA are for like first time home buyers, people that want to put down less than 20%, as low as 3.5% down. So if you have a $300,000 mortgage, right, you got to put down at least 2.5% on the FHA. All right, that's the lowest you could put in.
But with FHA, you can't do any payment assistance, right? Like
So grants and things like that,
Yeah.
you can still try to get federal grants for that. If you get a certain amount of grants, then it goes to CHAFA, which is
Okay.
another version, another stem off of FHA. So like I said, very complex. And as
Yeah.
you said earlier,
Yeah.
there's a lot to it. So I'm never going to try to explain this to every borrower because every borrower has a different area. So that's our job to understand it and then try to put you in the best of it. So that's why we're giving you a high overview of some of these products.
Yep.
And then if you are interested in buying a home or even buying a home in 6 months, we can kind of, set up a plan for you, which we'll be talking about a little bit later.
Okay. That makes
But
sense.
yeah, there's different down. So, we're talking about down payments. So typically you got to put down ten to $15,000 on a house just for the closing cost.
Right.
There are different products and programs where you can try to get that closing cost either for free from different grants if you buy in certain demographics, certain cities. And if not, there's different ways too. If you're the seller could potentially pay those for you. So there are different ways to navigate paying some of that closing cost, but it's not for everyone.
Yep.
And sometimes it's up to the seller, and in the last 2 years, the seller had all the power because everyone was buying, buying, buying. But now as things starting to shift, we
Yep.
will see different things come back from that with sellers offering to pay these things to sell their home.
Right. Right. So, like what you were just saying, some of these loans and programs aren't for everybody, but can everybody be pre-approved for maybe, some type of loan?
Yeah, so the pre-approval is all going to come down to the DTI, which is debt to income. So you need to have some source of income. If it's either a job, if you're getting Social Security, if you're getting unemployment, if you're getting some type of disability, that will help you determine what you can afford. So you need to have some type of steady income, proven income to determine. But everyone has the ability to get a pre-approved. Now, if you're not making enough, we would then let you know what you need to make, or you have to take less of a house, and maybe instead of a $200,000 house, maybe you can only afford $150,000 house. But everyone has the ability to get it pre-approved. There's pre-approved and pre-qualification. So if someone calls me today and they tell me they make $50,000, based on them making $50,000 and what other debt they have, I can determine what they can afford. But that doesn't really help any realtors because it's kind of just hearsay. It's kind of people talking. But if you want something factual, we'll need to pull your credit. We'll need to pull your income to see what your true income is and what your true debt is. I've seen some scenarios, someone's like, oh, I don't have any debt. But then when we pull it, they co-signed a student loan for their child. And that could take it apart. So there's a lot of things people don't think it's their debt, but they co-signed something years ago. It could have been a car payment, it could have been student loans, things like that. And that will take effect of your DTI, which is the debt to income, as we talked about earlier.
Right. I hear of that a lot. Like a lot of my clients with bad credit, they're like, I pay my bills on time, but it was just, I helped somebody out one time and they did me wrong. And
Yep.
that goes on too often.
Yep.
So another question. I don't really know how to word this in the best way, but a lot of people have their own money, right? That they don't have in the bank, or maybe it's a business that
It's involving more cash.
exactly, exactly.
Yep.
So under the mattress money, like money that they have from home, is that
Yep.
only allowed to be gifted to people, or is there any way that they could use money that isn't in the bank to do? How does that work under mattress
Yeah.
money?
So, this comes in a lot of scenarios. People like to put away money however they want to save. It helps them save, whatnot. You need to put in the bank at some point if you're planning on using it to buy a house. We typically go back 2 to 3 months worth of statements. So you're going to need to put that in there, and you might have to explain where it came from. But you need to have it in there. You can't, for example, if we need $15,000 for closing costs, saying, hey, you're going to pay that in cash, because the banks and any lender would not allow that, because we need to make sure the money's clean and make sure it's legit.
Right,
So if you have been saving money, however you were saving it, you can just start to, if you are planning on buying a house, start putting it into the bank. You can put it in one lump sum, you can put a little bit at a time. Whatever's you want to do, if you, I mean, I'm gonna take that last statement back. If you put in a little bit at a time, it could look fishy. So, like I said, you just have to explain where the money came from.
Right.
But yes, you are going to want to put in the bank because we are going to look for the last few months worth of statements. So if you're looking to buy in 6 months, if you put it one big sum in, a few months from now, we may not even see that big statement. We'll just that big deposit. We're just going to see where the money is still in there, because that's what we care about most, that the money is in there. You mentioned gifts.
Yep.
Yes, many people do gifts. It could be for their child, their first son or daughter, and especially in the world that we're coming from, especially in the East Coast, things are expensive. It is hard to buy your first home.
Right.
So sometimes parents, grandparents, family members will want a gift, and it's usually something to do with either the down payment or the closing costs.
Yep.
So whomever, any family member or friend can gift them money. If they are going to gift them money, there is a gift letter that the owner of the money will have to sign, and
Okay.
they may also have to prove where that money is coming from, that gifted money.
Okay.
And part of that is basically saying this is not a loan, this is a gift. You're not expected to pay it back, because if you are expected to pay it back, then that's another loan, and that affects your DTI.
Yep. That
So
makes
that's the difference.
that makes sense. So you were just saying that they look at 2 to 3 months worth of bank statements, but
Yep.
I also get clients to where their jobs are unstable. So how far do you look at job history?
Yeah, so you typically need a 2-year
2 years.
work history, especially if you are a small business owner. If you are a W-2 employee, which means that you get paid, a set amount each week, each month, you don't need to have a 2-year history for that. But for someone that is working, getting, depending on a lot of overtime, we go back on 2 years worth of overtime history. All
Okay.
right. So if someone made $70,000 last year with $30,000 of overtime, so it made $100,000.
Hmm.
That means we can't just assume that they're going to get $30,000 the following year. So we'll
Right.
look at the previous year, and if they only got 15,000, well, then we would average out the amount of overtime. Okay.
Okay. I
Um,
didn't know that. Yep.
yeah, so that's how that works. So, if someone just crushes 1 year of overtime, we can't just use that. We have to go on a 2-year history of that overtime. Okay. But we would look at their most recent and up-to-date income, because people get raises annually, usually, sometimes every 6 months.
Right.
So if someone was making, $22 an hour a year ago, but now they're making $28 an hour, we're going to use that, even
Yep.
if that is as of 2 weeks ago. As
Okay.
long as it's showing that that's what it is, that's what we would use. All right. So W-2 customers are easier because it is set in stone. People that have small businesses, it's a little trickier, because not only do we have to use the last 2 years of income, but a lot of businesses have business expenses. So people that write off the business expenses actually take away from their income. So someone may, as a small business owner, make $75,000, but if they bought a new vehicle and bought some supplies and they write those off as tax write-offs, well, that goes against your income, because now you're not claiming all that as income. You're saying, yes, I made 75,000, but I had to buy a $50,000 vehicle for my company to keep running. So
Yep.
now that's $50,000 taken away from there.
Got it. Got it.
So that's why small business owners, depending on how they do their taxes, sometimes trying to show that they buy all these different things for their business could
Yep.
hurt them on the buying side, because now they're not showing as much income as they're truly making, because they're putting it into the business.
All right. Well, that's a great tip. I never knew that. So on a different side, just with your knowledge, what is a good time to buy?
When it's best for you as the client, when you're ready to buy. People are scared of the interest rates right now. I know you and I spoke in the past. Well, buyers have more of the buying power right now, because less people are buying.
Right.
So that's why right now, current individuals I'm working with are getting a chance to get their closing costs paid by the lender, or I'm sorry, by the seller.
Seller.
Why? Because all these the last 2 years, when someone put a house on the market, it was literally being sold within 24 hours.
Yep.
So they had all the buying, all the selling power, and they were increasing their house value because people wanted it that badly. Now as rates are going up, less houses, I'm sorry, more houses because people aren't buying as much. There's more options out there. So these people that truly do want to sell, they are willing to pay some closing costs or lower their price of the house in order to sell. So go back to your point, when is the best time to buy? If people say, oh, I'm going to wait for the interest rates to go back down to 3.5% in 6 months from now, if that's what they think is going to happen, well, if they wait, well, then they lose all of that power we just spoke about because everyone's gonna be thinking the same thing as them.
Yep.
So, I learned, buy when you're ready, the house you want, right? Because that house is gonna be with you forever. The
Hmm.
interest rate you get won't be with you forever because you have options to refinance,
Yep.
to do different things, right? But if you think it's that your house and you get the price you want, buy it now. Don't wait for the interest rates to drop because if you do, there's going to be other people looking to buy a house. And now you're going to be in a competitive market with that house.
Yep.
And now you're trying to outbid someone, right?
And
Now you just waited for your interest rates to drop, but now you're paying more money. Whereas you could have bought it cheaper, maybe a little higher interest, but then down the road you could potentially refinance.
yep. Yep. That's the way that I tell everybody. So go along with that question, well, you kind of explained it a little bit earlier. What is a good amount of money that you should bring in when you're looking to buy? That's just a question that I get often.
Yeah.
There's a certain way that I tell people, but what
Yes.
would you say?
So you typically want you need at least the closing costs in your bank. So closing costs could be anywhere between $7,500 to $15,000 or more, depending on how the size of the house. So
Yep.
closing costs have to do with a bunch of fees, but a big part of it is the value of the house, if it's $300,000 or $500,000, and also the town you're buying in taxes. Because in the closing costs, you need to pay for usually 8 months worth of taxes.
Mm-hmm.
So if you're in a town that the taxes are $10,000 out of the 8 months, which is around 6,500 or so, that's the money you got to put up front. If the taxes in the town is only 6,500 for the year, then you only have to put up 4,500, give or take, right? So that's a big portion of the closing cost.
Yeah.
So you need to have the closing cost. Now, as I said earlier, there are programs where you can potentially get the closing costs for free, right? But if you apply for and get denied, and then you don't have the funds in the bank to pay for the closing costs, you're going to lose the house.
Yep.
And some lenders may not even want to go forward without showing that you can pay for the closing costs, just in case it doesn't go through. Because all those different grants and funds that people may go for, like the CHAFA that we spoke about, different grants in different cities, New Haven, Bridgeport, etc. Milford, I mean, every city has it. You can Google and look them up for these different grants. You can apply for it, but it's not guaranteed you're going to get it.
Right.
So
Right.
if you don't get it and you don't find this out until you start the home buying process, then you lose everything. So that's why it's always smart, if you're
Yeah.
looking to buy, at least have that closing cost in your bank account in order to pay for it, even if you don't plan on paying for it, just to show you can. So in case something goes wrong, you have the ability to buy
You need that
it.
money in your savings.
Yep.
And like a rule of thumb, could you say that closing costs typically are around 10% of the purchase price? Or is that just, here's
Let me do some math for you. I never looked at it that way.
I know you're a number
Um, no, it's gonna be way less than 10%.
10%.
Um, so like I said, on a $400,000 house, it's probably gonna be between, you know, 10 and $13,000, right? So 10% on 400,000 is 40,000. So it's not gonna be less than 10%.
Right.
Um,
Right. Right.
Now things that affect the closing costs is some people I've seen pay down the rate, right? And that to get a lower interest rate. So I think we're going to talk about points. So that's what. So what is a point? A point is things associated with your interest rate. So if the interest rate right now is 6.5%, but you want to buy it down 1 point, you can buy it down to 5.5% if you want. But if you do buy it down, you're paying for that. And typically 1 point is 1% of the loan. So that's how much that would be, right? So that's how that works. Now, if you are looking just to buy a house for a few years and sell, I would never suggest to buy down the interest rate because you're paying for that money up front.
Yep.
But if you think you're going to be living there for the next 30 years, sometimes it's worth it to pay $2,000 or $3,000 to get a lower interest rate because over 30 years, you will save money with a lower interest rate. And those are things that we could break down for you. But at the same time, if the interest rate is 6.5% and you're thinking to yourself that the interest rates might go down to 4% in a 6 months, 18 months, and you plan on refinancing, well, if you're going to refinance, there's no point of paying for that point because you're never going to regain that money.
Yep.
So when you pay for it, if you pay $2,000 right up front, you're not going to be able to regain that money back in a short period of time, but you could regain it and recoup it back after 15 years or 18 years.
Yep. With the
All right.
lower amount of payments that you're paying with the interest.
Exactly. So instead of, if you're paying $1,600 a month at 5.5% or 1,900 at 6.5%, well, that $300 times 12 months is $3,600 and so on and so forth.
Yep.
So
Yep.
that's how that works.
So you basically explained this too. Tell me a little bit about the pre-approval process. Like, is there do you just get a client and you just run their numbers and let them know
Yes.
the best situation, or is it something different from that?
Yeah, so I would start off with, okay, how serious are you buying? Are you just trying to get some basic numbers? Or are you looking to buy in 6 months, 12 months, or whatnot, just to see with that? But regardless, as I said, the pre-qualification, I can just give you over the phone to anyone via text just by talking, right? But people don't always know their number. So someone may say they make $70,000 a year, but they truly don't. Or as I explained, they think they're making $70,000 because they're getting all this overtime of recent, but we, as the lender, as the banks, can't just take what you made the last 4 months. It's over the last 2 years. So that changes, and that's all going to change your DTI, the debt income. But the easiest way to get a pre-approval, fill out the application, which takes 10 minutes online, upload a few docs, and let us pull your credit. Now we can see everything. We can see all your debt, we can see your income, and then we can give you a true pre-approval. That pre-approval will last for a good amount of time. Typically, if it's more than 3 months, we may have to run your credit again. And that's why it goes back to my original question. Well, if you're not looking to buy for 6 months or a year, I'm not going to run your credit yet because it's going to run out and I'm going to have to run it again. It's not good to keep running your credit because then it's going to lower your credit score.
Yep.
Okay.
Not by a lot, but it does.
What's that?
Not by a lot, but it does lower it.
Yes, correct. And but like I said, we wouldn't want to, put you in jeopardy if we're not serious about buying yet.
Yeah.
But I could run you some numbers based on what you said, just so you have an idea. Especially first-time home buyers, I love dealing with them. They're brand new. They're not really sure what they can afford based on the banks. They may say, oh, they want a $400,000 house, but it may not be realistic. Or they may be able to afford a $400,000 house, but the mortgage payment is $3,400. And they realize, okay, I can't afford that, but I can't afford that comfortably. So I don't want to get into that loan, right? So that's one of my first questions as well. Okay, what do you think or what can you afford comfortably a month? Because if someone tells me they can afford or they want to pay $2,500, well, I'm not going to talk to them about a $3,400 mortgage, even if they could afford it, because that's just outside of what they expect to pay.
Right. That makes sense. That's what I was just about to ask you. So why is it better to get a loan from you than a big bank? Is it cheaper, or is there any,
Yeah, I mean, so with banks, big banks, I mean, I came from a bank myself, not necessarily big bank, but good size. They just have one set of rates, and it is what it is with that. With different places like us who are direct lenders, we are directly lending, and we also have different options of rates. So it's not just coming from one source. We have a few different sources to pull rates. So we have more variety and more options.
Gotcha.
All right. We are able to control certain fees and try to help lower fees at certain times, whatnot. Some fees are set, but some things are flexible. Whereas it seems like with big banks, their fees are not flexible at certain things.
Okay, that makes sense. So, tell me a bit about a HELOC if you can. Do you
Yeah,
need equity? Is there a time limit like FHA, 1 year
yeah,
to make a move?
yeah. So HELOC is home equity loan. It's a line of credit on your home. Banks usually handle these, but you need to have typically about 70% of equity in the home. So a lot of banks lend at 80%. Some credit unions lend at 90%. Right. So what does that mean? So if the house is worth $300,000, you need to have equity in there to take money from. Okay. So if you have a $300,000 house, but you owe 290,000, there's no equity in there. Yes, in your mind is $10,000, but that is not enough equity. And the reason why banks use 80 or 90% is because house values increase and decrease all the time. So they need to be on the safer side. So if the house value decreases from $300,000 to 275, well, now if you owe 275, you don't have any equity. So that's how that works. So there's no set time period of when you can get a home equity. It's just about when you have equity in the home.
Do you get
So
a home with equity in it already? Like when somebody buys a home for a lower value, how does that work?
well, yeah, so there's two things. So people that the conventional loan that typically people put down 20%, right? So if they put in $100,000 on a $500,000 house, they have that 20% in. So they already have 20% in. So that next day they technically can't get a home equity because they have the 20% in, but there's no equity in there. Unless they found a lender that would lend up to 90%, then they would have that 10% of equity in there. Okay.
Okay.
Now that's how that works for putting money up front. I'm gonna get to your next point in a second. So if I put down 100,000 after 3 years of paying down my mortgage, if if it was a $500,000 mortgage and I put down 100,000 down, that means there's $400,000 I owe. If after 3 years that 400,000 goes down to 375, well now there's $125,000 worth of equity in that home. So
Right.
now there's some equity you can take out. And the line of credit is kind of like a credit card. It just sits there. And if you take out some money and you can use it for anything, for house repairs, for college, for vacation, whatever it is. But once again, you need to get approved for it for your debt to income, the DTI. So you got to be able to prove that you can afford that loan and your mortgage loan and anything else.
Okay.
What we've seen in the last few years is housing prices went up drastically, right? So if someone had a $300,000 house and they could have just bought it, or they could have been living there for 15 years, doesn't matter. But they look around and now their house was valued at from 300,000 to $375,000. Now they have a lot more equity in the house. So now they would be able to take out a line of credit if they can afford it based on the bank. So that's how that works. So a lot of individuals that already had a mortgage took out home equities the last 2 years because their value of the house was so much higher. So that gives them more room for the home equity. It gives them more money for their property. Does that
Side
make
note.
sense?
Yeah, side note. So, like the BRRRR strategy. I don't know if you heard of that. It's when you buy a house undervalued, and then you fix it up because it was already assessed at whichever value that it was at, and then you put, a couple dollars into it to bring it to market value or better, and now your house is worth more, and that was in a short amount of time. Let's say that you put the 20% when you bought it, you know. Well, is that a way that you could take a HELOC out still, or
Yep. Yep. Yeah, there's no timeline on it. So like I said, once the equity's there. So, especially people that are handy themselves. They can buy a $200,000 house and fix it up and put maybe 15, $20,000 into it, but that house is now, instead of being worth 200, it could be worth 260 or 270. And you put down 15, $20,000, but you increase the value by $60,000. So you might have lost 15,000, but you increased it by 260 or by 60,000.
and you could take that money out right away because the equity is there.
The equity is there, but once again, you'd have to, get approved for it,
Right, right.
showing that you can pay back the current mortgage, the new line of credit loan, and any other debt that you have. But yes.
Okay. That's a good gem too. I didn't
Yeah.
know that way.
Yeah. So in home equities, you can only have on your primary home. So sometimes people try to get a second or third house. You can't just have home equity lines of credit on every house.
Yeah.
You can't do it on investment houses. It has to be on your primary home.
Okay. So tell me a bit about the refinancing process. Is it a big process or is it just something that you speak to a big bank about and just a regular, you know,
Yeah, so it's easier than buying a house because it's just you're just refinancing your house. You're not worry about trying to buy a house from someone. It's already your house, but you have to fill out an application, send in your documents to make sure you can get approved of the refinance. People think, oh, why do you think that? Well, people change all the time. So if you bought the house 3 years ago, well, income could have changed. Someone could have lost a job. Someone could have changed jobs, right? Maybe when you bought the house, it was jointly with you and your spouse per se, and now the spouse is no longer working because there's a child involved. So now there's only one income. So you still need to get approved to refinance.
okay.
And then there's closing costs to refinance. But if what they say is if you could move it a full point or a full percentage, then it's going to be worth it to refinance. Because yes, it's going to cost a little money up front, but you're going to get it in the length of the 15, 20, 30 years that you're still living there.
That's a good
Right.
thing because I always wondered that. Like, what's a good percent that you would refinance? Is it
Yeah.
0.5? How long would that take? Or
Exactly. Yes. I mean, I've seen some people move at 0.75, and if they're going to be the next 30 years, it's a 30-year payment on 0.5, you'd still recoup the money. But typically 1% is when you would want to make the move.
okay,
And like I said, those closing costs when you're refinancing, if it's just called $8,000 to refinance, you don't have to pay for out of pocket necessarily. You can put on the back end of the mortgage.
yep,
So what does that mean is if you're refinancing a $200,000 house, instead of refinancing for 210, you could refinance for 220 and put in the closing cost. So you don't
got
have to pay for out of pocket.
gotcha. That makes sense. Um, so for people that are in a tough situation but they need something, is there anything off top like creative financing? Like, maybe if somebody has bad credit. And I just started working with a guy, I'm building my financial literacy and just being a better agent. And I've been learning a lot about credit. So there's so many different, things that you could do to build your credit. But just coming at it from an angle of somebody who doesn't have that financial literacy and doesn't know about credit, is there any creative ways of financing that they could get into a house or something?
Reach out to you so they can learn. That's what they want to do. I mean, everything's on the internet, so you can search different things. I don't know any websites off the top of my head of to learn about it, but just to speak overall about credit, you need to try to lower your credit card debt. A lot easier said than done if you can't afford it, but at least make payments. Don't be late.
Right.
We're gonna look back on 2 year history. So if banks, lenders, direct lenders, anyone sees consistent late payments on car loans, credit cards, student loans, anything like that, that is gonna take a factor into obviously your credit score, which you're already seeing, but just decision making. So credit is important. Some loans we could potentially get at a credit score of 580, but they're very difficult.
Yeah.
You typically need 620 or better in most cases. Like I said, you could get a house at 600, but all these things are going to cost more money. You're gonna may have to pay more points. That point is that 1% or 2% or 3% of the house value, and that would be part of closing cost. So credit score is important. So yes, I suggest trying to take
Enhance it.
care of it, and for younger people, first time home buyers, whatnot, if they don't have much credit established, well, you need to get some credit established. And the easiest way I say is get a small credit card, even if it's $200, right? Buy gas once or twice a week and pay it off in full. Buy groceries once or twice a week and pay it in full. Don't let it expand and overmax what you can't afford, but you got to use it and then
Right.
pay it off to get credit. Because if you just apply for a credit card but never use it, that's not going to also help your credit score grow or get better. So you got to use it. So even if you use it once or twice for something small and paying it off, that shows that you're being responsible with your money, paying it back, and it's going to help shoot your credit score back up. I've seen people improve their credit score in 6 months, 50, 60 points. You can move it up 20, 30 points in a couple of months if you do the right behaviors.
Right, right, right. So, not to drag you out and keep you forever, let me just ask you one last question. Um, Recommend me at least one book, for somebody who's curious about getting into the real estate industry, whether they want to buy, whether they're curious about investing, or if they wanted to become a mortgage broker, or give me one book that maybe
Yeah.
you were inspired by.
I like to just reading different articles, and I follow a couple of different things on Twitter and Instagram, whatnot. But you don't have to like some of these people, but like Elon Musk, right? He's very, very successful. I just like reading some of his things. Now, I may not always agree or disagree with what he's saying, but it's showing that he's he's got there, right? He started very, very low and he got there. So
Yeah,
it's good just reading people that are successful with what I would consider successful in the money industry and just seeing what they think on things and then try to be open-minded about it. And even if you don't agree with it, like, oh, okay, I see where they're coming from.
yeah,
But yeah, I mean, that's what I do. I like reading just different things like that from different higher ups.
yeah. Just following people who successful and
Absolutely.
walking in their footsteps. That's awesome. Yeah, no. Well, man, I appreciate your time and all your knowledge. I learned a lot during this little session. And whenever you have more knowledge to drop, just connect with me and we keep on building and closing these deals.
Absolutely. So yeah, like I said, anyone else that wants more information, please reach out to me. He's gonna put this on Facebook, whatnot. Please reach out to me, DM me, email me, whatever it is. I'd love to help. I'd love to break down more numbers for you. Like I said, a lot of this was overall high overview for everything. All right. I do see you got your New York Yankees symbol in the background. So
Yes,
let's go
yes, yes.
Yankees.
Let's go Yanks.
So we'll see how game one goes today. All right. But I appreciate your time today.
All right, man.
And we'll keep in touch.
Yes, sir.
All right, take
Talk
care.
soon. Thank you.
Bye.